Hi viewers, good evening. I am James Thomas from Sharjah Indian School. So this is a good platform for me to take the class, and not only for the students but also for all teachers. Is getting a good chance to evaluate the subject, and as well as those who are going to write the board examination, they are getting a good chance to evaluate the subjects. See, all my students, please listen to me. And we are already studied partnership. So you know what do you mean by partnership. So partnership means as per section 4 of the Indian Partnership Act 1932. So partnership means it is a relation between two or more persons who have agreed to share the profits or losses carried out by all or any of them acting for all. This is what is called partnership as per Partnership Act 1932. So today what I am going to explain, see what do you mean by partnership and how the partnership firm is dissolved, and we are already studied admission of partnership, retirement of partnership, and death of a partnership, death of a partners, etc., etc. So today what I am going to take, so dissolution of firm and dissolution of partnership. So here students have a lot of doubts. So what is the exact difference between dissolution of firm and dissolution of partnership? So here listen, so dissolution of partnership means only rearranging the relationship between the partners, or otherwise we are reconstituting the relationship between the partners. So it doesn't mean that we are going to dissolve the entire activities of the firm. Here only we are reconstituting the relationship between the partners or rearranging the relationship between the partners. This is what is called dissolution of partnership. So take one example. So A and B and C are partners. So here C is going to retire. So that means A, B, C, that particular partnership comes to an end, but A and B can reconstitute the firm. So this is what is called dissolution of partnership. Then so we have a lot of doubts. Then what do you mean by dissolution of firm? Dissolution of firm means complete breakdown the relationship between the partners is known as dissolution of firm. So complete breakdown the relationship between the partners forever is known as dissolution of firm. So that means tomorrow onwards firm is not there, so we cannot run the business. The entire activities of the firm is cancelled or terminated forever is known as dissolution of firm. So here we can see one by one. So what is the exact difference between dissolution of firm and dissolution of partnership? See the difference they are given. See, all of you look at the monitor. So please listen. So dissolution of partnership and dissolution of firm on the basis of meaning. So it means a change in the existing agreement between the partners. That is what is called a dissolution of partnership. But dissolution of firm means, it means the dissolution of partnership among all the partners of the firm. And also on the basis of settlement of accounts, assets and liabilities are revalued and new balance sheet is drawn after settlement of accounts. That is in the case of dissolution of partnership. But in the case of dissolution of firm, assets are realized and liabilities are paid off after the accounts are finally settled. Then you can see the termination of the business. The business of the firm is continued after dissolution of partnership. But in the case of a dissolution of firm, the business of the firm is closed down forever. In the case of dissolution of firm, we cannot continue the business. The business is closed down forever. That is what is called a dissolution of firm. Then the last point is in the effect. Dissolution of partnership need not necessarily result in the dissolution of firm, but in the case of dissolution of firm involves dissolution of partnership automatically. So I think it is clear what is the difference between dissolution of firm and dissolution of partnership. So actually the exact meaning is, after dissolution of partnership firm is continuing, but after dissolution of firm is not continuing, the entire activities are closed down and we are settling the accounts. That is what is called difference between dissolution of firm and dissolution of partnership. It is clearly mentioned as per section 39 of the Partnership Act 1932. So I think it is clear. So now we can look at the next part. See, what are the important modes of dissolution of partnership firms, or what are the different methods of dissolution of partnership firms? So you can see as per section 39, so there are two methods or modes for dissolution of partnership firms. The first one is dissolution without the order of the court, and second one is the dissolution by the order of the court. You can dissolve the partnership firm. So the case number 1, voluntary dissolution or dissolution without the order of the court. So that part is coming under section 40 to 43. Section 40 to 43 of the Partnership Act 1932. That is what is called voluntary dissolution or dissolution without the order of the court. But the other case, the compulsory dissolution or dissolution by the order of the court. So that is coming under section 44 of the Partnership Act 1932. So we can see one by one. See what are the different modes of dissolution. Number 1, voluntary dissolution or dissolution without the order of the court, and the second point, that is dissolution by the order of the court. So we can see dissolution without the order of the court. What are the different cases and reasons? So number 1, so by agreement, we can dissolve the firm by agreement. So what do you mean by agreement? As per the agreement, that means with the consent of all partners, we can dissolve the firm. With the consent of all partners, we can dissolve the firm. That is section 40. And the second point, you know that compulsory dissolution, that is section 41, compulsory dissolve the firm. That means happen something which makes unlawful for doing the business. Happening certain event which makes unlawful for doing the business. So section 41 of the Partnership Act 1932. So and third point, on happening of certain contingencies, that is section 42 of the Partnership Act 1932. So what do you mean by certain contingencies? Like a death of a partner, or otherwise if the partnership is for a fixed period, if the period is over, that particular partnership comes to an end, or the partnership is for a particular venture, that work is completed, automatically partnership comes to an end. So the last point is by giving a notice. If the partnership is at will, by giving a notice, a partnership comes to an end. So here you can see one by one. See what are the different modes of dissolution of partnership. Modes means method. There are two methods of dissolution of partnership. So number 1, dissolution without the order of the court, and this part is coming under section 40 to 43, and dissolution by the order of the court, this is coming under section 44 of the Partnership Act 1932. So here once again, so agreement, compulsory dissolution on happening a certain contingencies and by notice. So then second part is dissolution by the order of the court. The court is giving an order to dissolve the firm. Under what circumstances the court is giving a garnishing order, or court is giving a special order to close down the business. This is very, very important to the students who are going to write the board examination, because normally since 2009 onwards, board is continuously asking this question: what are the reasons for compulsory dissolution? So the first point is insanity of the partners. The partner become insane or unsound mind, so automatically that partnership comes to an end. And second point is permanent incapacity of the partners. So they cannot run the business, they are not obey the rules and regulations, they cannot run the business, they cannot protect the interest of the other partners. So here permanent incapacity of the partners, the partnership comes to an end. And the third point is, misconduct between the partners, lack of confidence. You know that we are already studied first chapter. So partnership is based on utmost good faith, or otherwise abri mai fedi, means utmost good faith. So lack of confidence, automatically the clash between the partners, so the partnership comes to an end. And the next point is the breach of agreement. You know that all contract is based on agreement as per our Indian Contract Act 1872. So that means here breach of agreement or breach of contract. So they are not obey the rules and regulations, or they are not fulfilling the conditions of the partnership, automatically partnership comes to an end. This is what is called the breach of agreement. And next, the transfer of interest. If any partner or group of partners are transferring their interest to third person. And the last point is the business is permanently working at a loss. No chance the business is permanently working at a loss. That means no chance they will get the profit. So these are the main reasons for compulsory dissolution. This is very, very important to the students. So what are the different, different reasons for compulsory dissolution? What are the different reasons for compulsory dissolution? So insanity of the partners, permanent incapability of the partners, and misconduct and breach of agreement and transfer of interest, and business is working at a loss. So these are the reasons for dissolution of firm by the order of the court. So in the above cases, the court is interfering and they are giving a final notice to the firm to close down the business. After getting this garnishing order from the court, we cannot continue the business, and this particular section is very, very important, and this section is coming under section 44 of the Partnership Act 1932. So listen, so next part. So how we can settlement of accounts on dissolution of partnership. So you know that in the case of a dissolution of firm, we want to settle the accounts. So first of all, the normal business is now closed down, we want to settle the accounts. The accounting treatments are, first of all, we are making a realization account, and we are making a partner's loan account, and we are making a partner's capital account, and finally we are making cash or a bank accounts. So these are the main ledger accounts what we are following at the time of dissolution of firm, because tomorrow onwards firm is not there, we want to settle the accounts. So that is why the procedure for settling the accounts is, first of all, we are preparing realization account, and the second we are preparing partner's loan, any loan is there, we are preparing a partner's loan account, and third we are preparing partner's capital account, and finally we are preparing cash or bank account. And here one doubt is there, in the case of admission and retirement and death, we are making a balance sheet. So that is reconstitution of the firm. So firm is continuing, their balance sheet is there. But here in the case of a dissolution of firm, we are not making balance sheet at last or end of the ledger accounts, and we are making a cash account and bank account, and cash and bank should tally, cash or bank account should tally. So once again, see what are the different type of ledger accounts we are preparing at the time of settling the accounts at the time of dissolution of firm. So first point is we are preparing realization account, and the second is we are preparing partner's loan account, and third one is we are preparing partner's capital account, and the last we are preparing cash or bank accounts. Okay, now we can see the monitor once again. See, what do you mean by realization accounts? This is the very, very important. Here also the students have a lot of doubts. So what is revaluation account and what is realization account? See, now first of all we are going to discuss what is realization account and what are the entries we are passing through the realization account, how to prepare realization account, and this we can see first, then we can see what is revaluation account and realization account difference. See, listen, so what is actually realization account? In the event of dissolution of a firm, a new account, a realization account is opened. It is a nominal account in nature. The purpose of this account is to find out the profit or a loss at the time of realizing the assets and making the payments, making the payment of liabilities. Any profit or loss is there, that should be transferred to the partner's capital account. See, once again, realization account, that account is like a nominal account in nature, and the purpose of this account is to find out the profit or loss on realization of assets and making payments. See, first of all we are realizing the assets, so we will get the money, and that money we are utilizing for the payment of liabilities. And after paying the liabilities, if any amount is remaining with us, and that amount we are transferring to the partner's capital account. So that means realization account we are preparing only at the time of dissolution of firm. Then we can see what are the accounting treatments and journal entries connected with the realization account. We can see at the time of dissolution, the partner's balance sheet is available. the balance sheet lot of items are there, like assets are there and liabilities also there. So first of all, we are transferring all asset to the realization account. The first point is we are transferring all asset to the realization account. So journal entry is realization account debtor to various assets. So when we are transferring all assets to the realization account, the journal entry is realization account debtor to various assets. Then afterwards we are transferring all liability to the realization account. So journal entry is various liabilities account debtor to realization accounts. Then so first of all, we are closing the items from the balance sheet to transfer to realization account. So that means all assets except certain exemptions are there, that I will discuss later. And first of all which we can convert to liquid money, and those assets we are transferring to the realization account by passing a journal entry is realization account debtor to various assets. Then second point, we are transferring all liability to the realization account. So journal entry is so all various liabilities account debtor to realization account. So then look at the monitor. So we can see the second step, that is for when we are selling the assets. So next point is we are realizing the assets. So we are realizing the assets means we are selling the assets and we are getting the money. So when we are getting the money, we are passing the following journal entry, that is cash account or bank account debtor to realization account. So this all marketable assets we are selling outside and we are getting the money, and that money so we are utilizing for the payment of liabilities. So when we are getting the money on the at the time of realizing the assets, so journal entry is cash account debtor to realization accounts. Then after getting the money, and that money we are using for the payment of liabilities. So journal entry is realization account debtor to cash account. When we are making the payments, so journal entry is realization account debtor to cash account. Then here you can see tomorrow onwards firm is not done. So out of that, one of the partner is taking any assets. So what is the entry? One of the partner is taking any assets of the firm. So what is the entry? So concerned partners capital account debtor to realization account. Concerned partners capital account debtor to realization account. See, once again I will repeat. First of all, we are transferring all asset to realization account. So journal entry is realization account debtor to various assets, and all the liabilities we are transferring to realization account. So journal entry is various liabilities account debtor to realization account. Then afterwards, these marketable assets we are selling outside and we are getting the money, and that money we are utilizing for the payment of liabilities. So journal entry is cash account debtor to realization account, and that money we are utilizing for the payment of liabilities. So journal entry is realization account debtor to cash. So meantime, any partner is taking any asset of the firm. So what is the entry? So entry is concerned partners capital account debtor to realization account. So one just opposite, if any partner is paying firm's liability, so journal entry is realization account debtor to concerned partners capital account. So the next, what about the realization expenses? So next part is, now we have studied assets are transferred over and the liabilities are transferred over. Then afterwards we are selling the assets, that's also over. After getting the money we are utilizing the payment, that also over. Next point is entry for the payment of dissolution expenses. These expenses you can see at the time of dissolution we are meeting lot of expenses, and either the partner is bearing or the firm is paying that expenses, whatever it is, we can see the for expenses borne by firm and paid by the firm. So what is entry? The entry will be realization account debtor to cash account. And for the payment of expenses made by a partner on behalf of the firm, so journal entry is realization account debtor to partners capital account. Then so the last point is, if the firm has agreed to pay a fixed amount to a partner towards the realization expenses, irrespective of the actual expenses, again one more, this is an exceptional entry, that is realization account debtor to partners capital accounts. See, Now once again I will repeat, because lot of entries are there before we are making realization account. See, lot of entries we supposed to study, then only we can prepare realization account, then only we will get the correct profit or loss. So that's why the students should be aware of all these entries. This is very, very important to your examination. So first of all, so we are getting a balance sheet, and that balance sheet we can see lot of assets and liabilities are there. And first of all marketable assets we are selling, first of all we are transferring all assets and liabilities, then afterwards all assets we are selling outside and we are getting the money, and that money we are utilizing for the payment of liabilities. So these are the main journal entries. Then if any unrecorded assets are there, if any unrecorded assets are realized, so entries just like we are realizing the assets, the cash account debtor to realization account. If any unrecorded liabilities are there, and also unrecorded liabilities account debtor to realization account. So that means, so here we are already studied all entries. The next point is, what about partners loan account? We can see that balance sheet liability side partners loan is there. So outside partners loan is there and partners loan is there. Outside partners loan is treated like a normal liabilities. We are transferring to the realization account and paid off. And what about partners loan, personal loan? So journal entry is partners loan account debtor to cash account. So partners loan we are preparing just like a realization account. So that is separate ledger should be there. That is what is called a partners loan account, and we are loan account is always showing a credit balance. So journal entry is partners loan account debtor to cash accounts. Then now listen. First of all, we are preparing a realization account, then we are going to prepare a capital account, and finally we are preparing a cash account. So now next procedure is we are preparing realization accounts, partners capital account. So partners capital accounts, so after preparing realization account, we are passing or we are preparing partners capital account, and finally we are preparing cash account. Then we can see some exceptional entries are there. So what all the exceptional entries connected with the realization account? The balance sheet you can see lot of exceptional items are there. So example, the balance sheet asset side, two items is given, that is profit and loss account and deferred revenue expenditures like advertisement expenditure. So what we are going to do, we are not transferring along with assets or along with the liabilities, and this is like a fictitious. So what we are going to do, so this we are transferring to partners capital account debit side. So journal entry is partners capital account debtor to profit and loss account or deferred revenue expenditure accounts. And next, another exceptional entry is, so you can see the balance sheet asset side, the provision for depreciation is there, and provision for depreciation is there, and investment fluctuation fund is there, and also joint life policy reserve is there. So this we are transferring to various liabilities and not paid off. So that is the accounting treatment. So the next so next point is, what is the format of a realization account? See, all of you please look at the monitor. See, format of a realization account. So I already explained what all the entries we are passing before making the realization account. Now we can see, this is just like a nominal account. We can see the ledger account, the format of realization account. So first of all, we are transferring all assets to the realization account by passing a journal entries to various assets. You can see in bracket some exceptional items are there, like this is very important, excluding cash or bank or fictitious asset and debit balance of profit and loss account and partners capital account and loan account we are not transferring. So what is the entry? So journal entry is the realization account debtor to various assets. And the second point is various liabilities account debtor to realization account. Here also some exceptional items are there, that is credit balance of profit and loss account and reserves and partners capital or current account and loan from partners. These entries we are not transferring. Only the creditors and overdraft and outside partners loan only we are transferring to various liabilities, passing the entries like various liabilities account debtor to realization account. The next point is all the assets we are selling outside and collect the money. So journal entry you can see cash account debtor to realization account, cash account debtor to realization account. And next point is, and after getting the money and we are utilizing for the payment of liabilities. So journal entry is you can see realization account debtor to cash account, and also the expenses made by the partners and the expenses made by the firm. So journal entry is realization account debtor to cash account. Now we can see, and just like unrecorded assets are there, so journal entry is cash account debtor to realization account, that means realization account credit side we are posting. So then afterwards, after preparing this realization account, the next procedure is we will take out the difference. If the credit total is more than the debit total, or the debit total is more than the credit total. If the credit total is more than the debit total, means it is a profit, and vice versa it is a loss. And if it is a loss, so we are transferring to partners capital account debit side, and if it is a profit we are transferring to partners capital account credit side. Now see, the next point is, now we have studied what do you mean by dissolution of firm and how it's differed from dissolution of partnership, what are the reasons for dissolution of firm, how the court is interfering and dissolve the firm, then what are the different points connected with the settlement of the accounts. We are preparing realization account, we are preparing partners capital account, and we are preparing cash or a bank account. These are the different ledger accounts we are preparing. Now after discussing all these points, now we can clear the doubt of the students, that is distinction between revaluation account and realization account. This also, you know, I want to make it clear. So what is actually the difference between the revaluation account and a realization account? You know that revaluation account we are preparing only at the time of admission, retirement and death of a partners. But realization account we are preparing at the time of dissolution. So you can see that first in the case of an admission, and in the case of retirement, and in the case of a death of a partner, first of all we are preparing an account is known as a revaluation account. But you know that the lifetime only once we are preparing the account is known as realization account. The next point, what is the main object of preparing this revaluation account and a realization account? See, point is, this account is prepared to make necessary adjustment in the value of assets and liabilities. So you can see the revaluation account, what we are putting in the revaluation account, if the assets are increasing credit side, and if the assets are decreasing debit side, and also if the liabilities are increasing debit side and the liabilities are decreasing credit side, and afterwards we are taking the difference between the credit total, debit total, either we are getting a profit or a loss. That means the appreciation and depreciation we are posting through an account is known as revaluation account. But in the case of a realization account, no question of appreciation and depreciation. A realization means actually we are realizing the assets and we are collecting the money, and that money we are utilizing for the repayment of liabilities. The first point is when we are preparing this revaluation account and when we are preparing this realization account. And the second point is what is the main objects for preparing the revaluation account. And the third point is what is the result. Even after the preparation of revaluation account, the firm is continuing the function. You know, that's very, very important. You know, after preparing the revaluation account, the firm is continuing. But in the case of after preparing the realization account, firm is no more and firm is going to dissolve, and we are break down the relationship between the partners forever, or terminating the entire activities of the business units or the relationship between the partners forever, or tomorrow onwards we cannot continue the business. And then you can see the last point is when we are preparing this revaluation account. Revaluation account at any time we can prepare, but The realization account we are preparing only at the time of dissolution of firm. So, realization account we are preparing only at the time of what? Realization, only at the time of dissolution of firm. So, then now listen, see, look at the